There is a familiar adage within the intelligence community. The most vocal threats are seldom the most perilous. It is the silent ones, the unassuming presences, that command genuine apprehension. In the realm of financial markets, we are predisposed to seek out ostentatious displays. We are drawn to the explosive upward surge of a green candlestick, the dramatic plunge of a red one signaling widespread panic, and the spectacle of rampant volatility. However, observing the current trajectory of silver, particularly in the vicinity of $60, reveals an unusual phenomenon. One witnesses a distinct lack of movement. The price remains static, churning without significant progress. It nudges downwards by a mere few cents only to rebound, or ascends by a similar margin before halting abruptly. To the average retail investor, this might appear as stagnation, a sign that the upward momentum has faltered, or perhaps that the market itself is indecisive. Yet a more profound examination, a peeling back of the superficial price action to scrutinize the underlying volume, unveils an entirely different narrative. It reveals a battlefield. Over the course of the recent trading sessions, billions of dollars worth of financial instruments have been directed towards this market. Financial institutions have engaged in short selling, and automated trading systems have offloaded significant positions. Despite this concerted selling pressure, the price steadfastly refuses to break downwards. The reason for this resilience lies in the presence of a formidable force. Someone substantial, possessing resources far exceeding those of the major bullion banks, has placed a limit buy order of such immense magnitude that it is absorbing the entirety of the global silver supply without wavering. We are presently observing the emergence of a colossal player, a mega whale. This is not a spontaneous retail-driven surge, nor is it a hedge fund seeking fleeting profits. Instead, this represents a strategic acquisition by an entity amassing a position destined to irrevocably alter the global power dynamics. Throughout this four-part investigation, our objective is to track this powerful entity. We will employ sophisticated forensic analysis of market data to substantiate the significant transfer of wealth that is currently underway. We will meticulously connect the dots between the burgeoning artificial intelligence sector, the escalating energy crisis, and the perplexing disappearance of physical silver. Ultimately, we will demonstrate why a flat price coupled with robust volume represents the most compelling bullish indicator on the planet. The market is not stagnant, it is consolidating, preparing for an ascent. It is imperative to align yourself with the interests of this powerful accumulator. To comprehend the activity observed in the $60 range, one must first grasp the methodologies employed by informed capital. Should an individual like ourselves wish to acquire silver, we would typically access our brokerage account and execute a market order. This would result in a minor price increment as our shares are secured. However, endeavoring to purchase silver to the tune of $650 million, equivalent to approximately 10 million ounces, is an entirely different proposition. Executing a market buy order in such a scenario would instantaneously propel the price to $100, resulting in substantial slippage and severely compromising the entry price. Consequently, a different strategy is employed: the iceberg order. An iceberg order is a specialized algorithmic trading strategy utilized by institutional investors. It involves placing a small, visible portion of an order on the trading books, perhaps 5 contracts, while concealing a considerably larger order, possibly 50,000 contracts, within a dark pool. Each time a seller initiates a transaction against the visible 5 contracts, the algorithm automatically replenishes the displayed quantity. This process of selling and replenishing, repeated ad infinitum, effectively pins the price at the predetermined limit without eliciting significant upward movement. The volume indicators, however, register a substantial surge, mimicking the operation of a turbine. Sellers are led to believe there is an inexhaustible demand at that price level. Eventually, their selling capacity is exhausted. Once this selling pressure subsides, the accumulator withdraws the protective price wall, leading to a sharp and dramatic upward price movement. This precise dynamic is unfolding before us at present. Examining the silver chart in the $63 zone, one observes that every attempt by financial institutions to depress the price is met with an unyielding, invisible barrier. The price does not bounce, it simply ceases to decline. This abrupt cessation signifies the powerful accumulator's intervention. Based on our analysis of the trading volume over the past 48 hours, we estimate that a single entity has absorbed between 10 million and 15 million ounces of silver. This equates to a capital investment of approximately $650 million to $1 billion. The question arises, who possesses such substantial financial capacity? It is not a conventional hedge fund, as such entities typically exhibit caution towards commodity markets. It is not a collective of retail investors. Their resources are largely depleted. Nor is it a bullion bank, whose modus operandi usually involves selling into rallies, not defending price floors. This distinct market footprint suggests a strategic corporate entity. This is a company that requires the metal not for speculative trading, but for its very survival. Such an enterprise views the $63 price point not as costly, but as an indispensable form of insurance. We are witnessing an unprecedented accumulation phase. The longer the price remains stable, the more pronounced the subsequent price explosion will be once the accumulator has completed its acquisition. The current consolidation phase represents a significant transfer of ownership, a transition from hesitant holders to robust custodians. Let us clearly define the participants. The hesitant holders are speculators who acquired silver at $50, anticipating a swift profit. They are currently experiencing apprehension. The price stalling at $63 instills in them a fear of a substantial decline. Any minor dip triggers their panic, leading to sales. They are, in effect, providing the necessary liquidity. The robust custodians are the buyers. They exhibit no nervousness. Their investment horizon extends over a decade. They are actively purchasing during periods of market distress. This process, whereby speculative investors divest and long-term holders increase their positions, is fundamental to the emergence of a supercycle. It establishes a solid foundation. Consider the construction of a skyscraper. A structure built on unstable ground will inevitably collapse, whereas one erected on a concrete foundation will endure indefinitely. The $63 level is solidifying into this concrete foundation. The fact that the price is not collapsing, despite significant prior gains, indicates a fundamental shift in the market's character. In 2011 or 2020, any sharp upward price movement was invariably followed by a decline. This was attributable to speculative trading driven by hype. When the excitement waned, the price followed. Today, the hype has dissipated, yet the price remains firm. This is the definitive indicator. Demand is no longer optional. It is imperative. Someone must acquire the metal. This ownership transfer remains imperceptible to the casual observer. The casual observer views a flat price chart and concludes that silver has lost its appeal. The professional, however, observes a flat chart accompanied by high volume and infers that silver is being deliberately consolidated. We are witnessing the market's available supply being systematically drawn into a vortex. Once all the hesitant holders have exited, once the last apprehensive speculator has relinquished their position to the accumulator, there will be no remaining sellers. At that juncture, the price will enter a phase of unhindered discovery. However, a pertinent question arises. Could this activity not be attributed to banks covering their short positions? This is a frequent inquiry. Is this simply J.P. Morgan closing out its positions? It is a valid question, but the available data strongly suggests otherwise. The forensic evidence is compelling. Evidence 1 pertains to the timing of the transactions. Institutional buying from banks typically occurs during designated fixing periods or immediately prior to market close. The buying we are observing, however, is continuous and pervasive. It is evident during the Asian trading session, the European session, and even in the United States pre-market hours. This pattern indicates systematic accumulation designed to minimize market impact. Banks covering short positions generally exhibit more erratic and urgent behavior. This particular buyer, by contrast, demonstrates remarkable composure. Evidence 2 relates to physical premiums. If this were merely paper short covering, the disparity between paper and physical silver prices would narrow. Instead, this spread is demonstrably widening. Physical premiums in Shanghai and on the United States wholesale market are experiencing an upward trend, even as the paper price remains stagnant. This phenomenon strongly suggests that the buyer is taking physical delivery, effectively removing the metal from circulation. Banks, by their nature, tend to merely roll over their paper contracts. This buyer, however, has a clear intention to possess the physical commodity. Evidence 3 concerns sector rotation. Observing the broader stock market, while silver is undergoing this accumulation, other sectors are also showing strength. Copper prices are firming, uranium is experiencing upward pressure, and technology stocks associated with artificial intelligence are also advancing. The correlation is shifting. Silver is becoming decoupled from gold and increasingly correlated with the electrification sector. This observation suggests that the primary buyer is an industrial entity. They are treating silver as a critical raw material, akin to copper or lithium, prioritizing supply chain security over speculation on currency depreciation. Therefore, if the buyer is neither a bank nor a retail investor who possesses $30 billion in capital, requires substantial energy resources, and harbors significant concerns about supply shortages, the answer points towards major technology corporations, specifically the hyperscale artificial intelligence providers such as Microsoft, Google, and Amazon. In the subsequent segment, we will elucidate the connections that Wall Street is reluctant to acknowledge. We will examine the trillion-dollar artificial intelligence revolution and the critical role silver plays in its unfettered development. We will also scrutinize the recent collaborative initiatives between BlackRock and Microsoft. What precisely constitutes artificial intelligence infrastructure? It encompasses data centers, power grids, and vast solar installations, all of which are intrinsically linked to silver. The enigmatic whale is not a mystery. It is the world's most influential industry, realizing a critical oversight: the failure to secure essential components. The notion that data is the new oil has been widely disseminated, but data requires energy, and energy, in turn, necessitates metals. We are witnessing a paradigm shift from a purely digital economy back towards a tangible, physical economy. Artificial intelligence does not exist solely within the cloud. It is materialized through silicon chips that are powered by electricity, which is efficiently transmitted by silver. An artificial intelligence query consumes 10 to 30 times more electricity than a conventional Google search. The existing power grid is incapable of meeting this escalating demand. Consequently, leading technology conglomerates are undertaking the construction of their own independent power grids. They are erecting massive solar arrays to energize their data centers and are increasingly recognizing the limitations of the current silver market to satisfy their burgeoning requirements. This has led them to proactively address the anticipated shortage, securing supply well in advance of manufacturing commencement. In the second part of this series, we will delve deeply into the artificial intelligence energy crisis. We will perform precise calculations to determine the quantity of silver that Microsoft will require to power advanced AI models like ChatGPT-5. Furthermore, we will explain why the clandestine buyer currently operating at the $63 price point is merely the vanguard of a much larger influx of demand. The established financial institutions are contending with the past, while this powerful accumulator is investing in the future. For those who have followed the initial segment, the identity of the buyer has been established. We know that a significant strategic entity, most likely a technology giant, is systematically acquiring every available ounce of silver at the $63 price point. We understand that this acquisition process is characterized by its calm, algorithmic, and relentless nature. Now we must address the fundamental question: why? Why would a software-centric corporation demonstrate such a profound interest in a precious metal? What compels entities like Microsoft, Google, or Amazon to covertly accumulate silver? They are not engaged in the production of jewelry, nor are they minting coinage. Their objective is the construction of the brain. We are in the nascent stages of the artificial intelligence revolution. While Wall Street remains fixated on semiconductor manufacturers like Nvidia and AMD, they are overlooking a critical element: the power consumption. Artificial intelligence does not subsist on air. It thrives on electricity. A standard Google search consumes approximately 0.3 watt-hours of energy. In contrast, a ChatGPT query demands roughly 3 to 10 watt-hours, representing a 10-fold to 30-fold increase in energy intensity per interaction. As artificial intelligence models evolve and approach artificial general intelligence, the energy demands will escalate exponentially. The existing power grid, a system that is both antiquated and fragile, is operating at its absolute capacity and is fundamentally incapable of supporting these burgeoning requirements. Consequently, the major technology firms are confronting an existential challenge. They possess the advanced processing chips, the sophisticated software, and a vast customer base, but they lack the essential power infrastructure. In the second installment of this series, we will expose the ramifications of the artificial intelligence energy crisis. We will meticulously connect the substantial AI infrastructure funds recently announced with the perplexing disappearance of physical silver. We will elucidate the compelling reasons why corporate commitments to achieve net zero emissions have placed big tech in a precarious position, with the only viable escape route being the massive acquisition of silver. The powerful accumulator is not engaged in price speculation. Rather, it is acquiring electrical energy in its solidified form. We are not required to guess the actions of these major players. They have, in essence, disclosed their intentions, though perhaps not through conventional channels. In late 2024, a partnership was unveiled that fundamentally reshaped the global landscape. BlackRock and Microsoft jointly launched a $30 billion fund dedicated to artificial intelligence infrastructure. A closer examination of the fund's prospectus reveals its objectives. What precisely constitutes AI infrastructure? It extends beyond mere server installations. The press release explicitly outlines the construction of data centers and the essential energy infrastructure required to power them. $30 billion is a staggering sum. To provide context, the total annual global production of silver was valued at approximately $25 billion. This single fund possesses more capital than the entire annual output of the silver mining industry, and this figure pertains solely to Microsoft. Amazon has pledged billions towards renewable energy initiatives, Google has committed substantial investments, and Meta has likewise allocated significant capital. Collectively, these entities command a war chest exceeding $100 billion, specifically earmarked for the development of power generation capabilities. The critical constraint is their publicly stated commitment to achieving carbon negative or net zero status by 2030. This precludes the construction of coal or natural gas power plants. Nuclear facilities require a decade for development, and wind power is inherently unreliable. This leaves only one scalable, readily deployable, carbon-free energy source capable of rapid implementation: solar power. They require solar energy, not in the form of a few rooftop panels, but on a gigawatt scale, necessitating vast solar farms spanning entire regions to power their data centers. As previously established, the production of high-efficiency TOPCon solar panels is dependent on the availability of silver. Therefore, let us consider the financial implications. If Microsoft intends to invest $10 billion in solar infrastructure, and silver constitutes approximately 10% of the cost of a solar panel, this translates to a direct silver demand of $1 billion from this single corporation. This figure aligns precisely with our observations of the iceberg order. The accumulation of approximately $650 million observed at the $63 price point does not represent the actions of a hedge fund, but rather a procurement department. It is likely Microsoft or an entity acting on its behalf, securing the essential raw materials to safeguard its $30 billion investment from the repercussions of a silver shortage. They are procuring the silver paste even before the construction of the solar farms commences. Their rationale is that delaying procurement until after the farm's approval would render the necessary silver unavailable. However, skeptics might argue that solar panels are becoming more efficient, thus requiring less silver per watt. While this is true, and a trend of silver thrifting is indeed evident, it inadvertently triggers Jevons paradox. This economic principle posits that as technological advancements increase the efficiency of resource utilization, the overall consumption of that resource tends to rise rather than fall. The reason for this is that as solar technology becomes more efficient, it also becomes more cost-effective and generates greater power output. Its reduced cost incentivizes increased deployment, leading to its integration not only in buildings but also in vehicles, windows, and extensive desert-based solar farms. The efficiency gains in silver usage are being overwhelmingly eclipsed by the sheer volume of deployment, a trend exacerbated by the demands of artificial intelligence. An AI data center operates continuously, necessitating a reliable baseload power supply. To power a data center using solar energy, it is insufficient to simply construct enough panels to meet daytime demand. The solar array must be overbuilt by a factor of 3 or 4 to charge the substantial battery storage required to sustain operations throughout the night. Consequently, for every gigawatt of AI computing capacity, 3 to 4 gigawatts of solar generation capacity are necessary. This multiplier effect is the critical factor driving silver consumption. The leading technology corporations are acutely aware of this dynamic. They have conducted extensive simulations and understand that achieving net zero emissions for AI is mathematically unfeasible given the current global silver supply. This leaves them with two primary strategic options: either abandon the pursuit of AI, which is highly improbable, or abandon their net zero commitments, a move that would be catastrophic from a public relations standpoint. The third and most practical option is to establish control over the silver market. They have unequivocally chosen this third path. Their objective is not to artificially inflate the price itself is of secondary importance to them. To entities like Microsoft, a silver price of $100 would be statistically insignificant. For them, silver is merely a construction material, akin to concrete or steel. Its availability is paramount. This explains the specific market behavior we are observing, particularly the implementation of iceberg orders. They are not actively driving the price upwards. Instead, they are establishing a price floor, signaling their willingness to acquire all available supply at $63, encouraging continued selling. They are effectively draining the swamp. This strategic shift represents a transformation in corporate policy not seen since the era of Henry Ford. In the 1920s, Henry Ford recognized the necessity of vertical integration, acquiring not only iron mines, but also rubber plantations and coal mines to ensure control over his supply chain. For the preceding 50 years, corporations largely moved away from this model, relying on just-in-time inventory management and delegating supply chain responsibilities to the open market. However, the era of just-in-time delivery effectively concluded in 2020 with widespread supply chain disruptions, chip shortages, and factory shutdowns. Corporate leaders learned a critical lesson. A lack of direct ownership translates to a lack of reliability. We are now witnessing a resurgence of vertical integration. Tesla is investing in its own lithium refining capabilities. General Motors is making strategic investments in mining operations, and leading technology firms are now establishing strategic reserves of critical metals. They are, in essence, transforming into sovereign entities. Microsoft possesses greater financial resources than many nations, and Apple wields more influence than numerous governments. Why would they entrust the consistent delivery of their vital silver supply to external intermediaries? They would not. They are constructing their own secure storage facilities, possibly located in regions such as Nevada, Texas, or Ireland. Warehouses are accumulating significant quantities of industrial-grade silver, not for speculative trading, but for direct utilization. This silver is being permanently withdrawn from the global market's available supply. It will not appear in standard inventory reports, nor will it be accessible for banks to lease. This constitutes dark inventory. Due to its hidden nature, the market remains largely unaware of the actual tightness of the supply. We observe reported inventories of 30 million ounces in the public domain, yet we remain unaware of the additional 50 million ounces held in private vaults owned by shell companies associated with Alphabet Inc. The accumulator operating at the $63 price level is constructing a formidable stronghold. Once this stronghold is fully provisioned, they will cease their price support activities. By that time, however, there will be virtually no silver remaining for anyone else. Therefore, we have identified the primary actors, major technology corporations. We have elucidated the underlying motivation, the burgeoning AI energy crisis. We have detailed the methodology, iceberg orders, and the utilization of dark inventory. The crucial question that remains is, what are the implications for you? What does this mean for the retail investor holding a modest collection of silver eagles? It signifies that you're now navigating a complex environment alongside powerful entities. However, for the first time in historical record, these powerful entities are acting in alignment with your interests. They are actively suppressing the price to facilitate their own acquisitions. Subsequently, they will be keen to see the price surge dramatically to disadvantage their competitors. In the third segment of this investigation, we will examine the collateral impact of these developments. We will explore the consequences for other industries that rely on silver when the dominant players consume all available resources. What will be the effect on the medical sector? What will be the repercussions for the jewelry market? Most importantly, we will guide you on how to strategically position yourself to benefit from their substantial buying power, rather than being adversely affected by their market influence. The clandestine buyer is presently maintaining a firm stance at $63. This represents a clear signal. The window for accumulation is open, but it is rapidly closing. Do not miss the third installment. The financial maneuver becomes deeply personal. If you have been following this comprehensive investigation, a rather stark and concerning picture is beginning to emerge. We have identified the powerful accumulator operating at the $63 price level. This entity is not a speculative investor. Rather, it represents the convergence of the artificial intelligence industrial complex. It is the collective might of big tech and global energy sectors, securing the physical silver essential for the construction of the future's power infrastructure. They possess a financial war chest exceeding $100 billion, a mandate to achieve net zero emissions, and are currently absorbing the global silver supply through extensive discrete iceberg orders. However, a critical question remains largely unaddressed. What will be the impact on everyone else? The silver market operates as a zero-sum game. Approximately 830 million ounces are mined annually. If corporations such as Microsoft, Amazon, and Samsung suddenly require an additional 200 million ounces, that metal must be sourced from existing supplies, meaning it will be taken from someone else. In economic terms, this phenomenon is known as crowding out. When a dominant entity enters a space and commandeers all available resources, smaller participants inevitably struggle to survive. In the third segment of this series, we will meticulously examine the collateral damage stemming from this unprecedented accumulation. We will investigate the industries that are poised to experience a severe scarcity of silver. We will address the potential medical crisis and the resulting military apprehension that such shortages will inevitably create. Most crucially, we will instruct you on how to effectively draft behind the whale, enabling you to leverage their purchasing power to safeguard your wealth rather than being overwhelmed by the ripple effects of their actions. The technology giants are actively consuming resources, while everyone else is on the precipice of scarcity. When discussing silver, our focus typically gravitates towards its monetary value or its application in solar technology. We often overlook its critical role as the most potent antimicrobial element known to science. It is indispensable in modern medical practices, appearing in burn creams, in catheters to prevent infection, and in surgical instruments. Furthermore, silver is an essential component in military hardware. A Tomahawk cruise missile, for instance, contains approximately 500 ounces of silver. The reason for this is silver's unparalleled conductivity of electricity. In a guidance system controlling a weapon valued at millions of dollars, the choice is clear. The best available conductor is utilized. Torpedoes employ silver-zinc batteries, and the cockpits of fighter jets feature silver-coated glass. The fundamental challenge lies in the inelasticity of demand from the medical and military-industrial sectors. A hospital cannot reasonably declare silver is prohibitively expensive. We will opt for plastic instead. Such a decision would have fatal consequences. Similarly, the Pentagon cannot simply dismiss the elevated cost of silver and forego essential technological components. Let's produce less expensive munitions. This leads to defeat. So, what transpires when the colossal tech entity procures the entire stock at $63? The Defense Logistics Agency takes notice. The hospital supply chains become aware. They discover their just-in-time deliveries are delayed. They contact the smelter. The smelter replies, "Apologies, Samsung has acquired everything." This ignites a fierce bidding contest, not among day traders, but between national defense imperatives and public health requirements. The United States military holds the superior claim. They can activate the Defense Production Act, legally commandeering the silver before it reaches Apple. However, Apple possesses the capital and existing agreements. This conflict creates an upward void. If the military seizes the supply, Apple must bid more aggressively for the remaining meager amounts. Conversely, if Apple secures the supply, the military faces paying a premium to reroute it. This constitutes the unintended repercussions. The tech giant's intention wasn't to provoke a crisis in the healthcare sector, yet by monopolizing the available stock, they have inadvertently pressured the most critical global industries. As an investor, grasping this is crucial. You are not speculating on an unsustainable surge. You are holding an asset that major players like Raytheon, Pfizer, and Microsoft are vying for, a remarkably secure position. Consequently, who bears the brunt? If technology, defense, and medicine are all in need of silver, who ceases their acquisition? Who is forced out? The jewelry and tableware sectors. These are discretionary markets. India, for instance, consumes a substantial quantity of silver for adornments like anklets and bracelets, as well as for its tableware. This is deeply ingrained culturally and serves as a means of wealth preservation. However, there exists a price threshold beyond which cultural practices yield to financial realities. When silver reaches $50, $60, or $70, Indian demand shifts from purchasing to selling. A homemaker in Mumbai, observing her silver platters, might decide that represents a down payment on a home. She then sells it to the refiner, who melts it down, and that silver subsequently goes to Samsung. This is the recycling loop, the market's sole pressure release mechanism. The massive buyer at $63 is banking on this. They anticipate that the elevated price will encourage the liquidation of silver from the decorative market, making it available for industrial consumption. However, here's the complication. This recycled supply is finite, and its acquisition is a gradual process. Persuading 1 billion individuals to relinquish their jewelry takes time. Collecting, melting, and refining it to 99.9% purity is also time-consuming. The tech conglomerate requires the silver immediately. The recycling process spans years. This disparity between the urgent industrial demand and the sluggish recycled supply is precisely what drives prices to surge excessively. We are on the verge of witnessing the demise of the decorative silver market. Silver is becoming too valuable to wear. It is becoming too valuable to dine with. It is reverting to its essential purpose, strategic industrial application. If you possess silver jewelry, retain it. It may represent ownership from the last generation that could afford it. Now let's consider your role. How should you navigate this? You are not a dominant player. You cannot single-handedly influence the market. Attempting to contend with the major buyer will result in your subjugation. Trying to anticipate their moves will lead to being dislodged by market fluctuations. The recommended strategy is to draft. In racing, drafting involves positioning oneself behind a larger vehicle, thereby reducing wind resistance and allowing for greater speed with less energy expenditure. The substantial buy order at $63 acts as your lead vehicle. The major entity is investing billions to maintain this price level, absorbing selling pressure and establishing a price floor. Your approach involves 3 key points. First, resist complacency. The dominant buyer desires you to become indifferent. They aim for a stable price so that you lose interest and sell to them. Do not sell. Complacency is a trap. Second, purchase at the base. Each time the price approaches the lower boundary of this trading range, make a purchase. You are buying alongside the dominant entity. Place your stop-loss order just below their significant buy level. If they withdraw, you should too, but as long as they remain, you are secure. Third, monitor the trading volume. As long as volume remains high and the price is stable, accumulation is occurring. When volume decreases, it signifies the dominant buyer is fully provisioned, and this is when the price is poised for a sharp ascent. If you are acquiring physical silver, where should you store it? The dominant buyer is not utilizing standard exchange, vaults, or bank-safe deposit boxes. They are opting for private non-bank storage facilities. You should follow suit or secure it yourself. The drafting strategy is straightforward. Identify the principal acquirer, emulate their actions, and await their catalyst for price appreciation. Currently, the primary buyer is accumulating at $63, signaling through their capital outlay that this price point represents excellent value. Who are you to dispute an investment of $30 billion? Therefore, we are aware that the major buyer is present, that they are absorbing available supply, and that they are creating pressure on both the military and the jewelry market. However, a massive buy order cannot persist indefinitely. Eventually, sellers will be exhausted. Eventually, the dominant entity will complete its acquisition. Eventually, the limit buy order will be rescinded. What happens at that precise moment? The vacuum. When the substantial buy wall at $63 vanishes and no sellers remain, having been entirely acquired by the dominant entity, the price does not incrementally rise. It instantaneously jumps. It leaps from $63 to $65, then to $68 within minutes. This is the unleashing of pent-up energy. In the subsequent section, the concluding chapter, I will guide you through the breakout phase. I will reveal the specific technical targets that become relevant once the $65 barrier is breached. Furthermore, I will furnish you with the warning indicators that signal the dominant buyer has concluded their accumulation and is prepared to allow the price to surge. The accumulation phase is the unexciting part. The upward price movement is the exhilarating part, and it is imminent. We have reached the culmination of this investigation. We have identified the major player, the artificial intelligence technology complex. We have determined their objective, the $30 billion energy crisis. We have identified the affected parties, the defense and healthcare sectors. Presently, we are observing the final moments of the accumulation phase. The price of silver has been deliberately held at $63 for a specific reason. It was not merely stuck, it was actively maintained. The dominant entity placed an immense iceberg order to absorb every available ounce of liquidity. However, there's a characteristic of these large players. They eventually reach their capacity. The $650 million purchasing program will not last eternally. The limit buy order will eventually be withdrawn. And when that occurs, when the artificial price ceiling is removed, we enter the most dynamic phase of any bullish market, the markup phase. In this final analysis, I will meticulously detail what transpires when the dominant entity disengages. I will elucidate the vacuum effect that exists just above $65. I will chart the technical trajectory towards $85 and beyond, and I will equip you with the essential psychological resilience required as the most challenging aspect of investing is not enduring a market downturn, but holding on through a vertical rally without capitulating prematurely. The accumulation is complete. The surge begins now. Let us examine the volume profile of silver. This analytical tool illustrates the price levels at which the most trading activity has historically occurred, revealing the market's collective memory. We have established a substantial volume base in the 20s. We have now constructed a considerable volume base in the low 60s. However, observe the price levels above $65. Reviewing chart history dating back to 1980 and 2011, the price spent negligible time in the 70s or 80s. It ascended through them instantaneously and then plummeted through them just as rapidly. This creates a void. There are no prior investors at $75 awaiting an opportunity to recoup their losses. There is no residual supply pressure. There is no institutional recollection of price action at these higher levels. Consequently, there is zero resistance. Once the price surpasses the gamma barrier at $65, it enters a vacuum. Within a vacuum, the principles of physics alter. A minimal buying impetus results in a substantial price movement. If the dominant entity purchases 1 million ounces at $63, the price might rise by 10 units. However, if they acquire 1 million ounces at $68, the price might only increase by 5 units. The reason is the absence of sellers. The sellers were effectively removed at $63. The only remaining holders are those with unwavering conviction, anticipating prices well over $100. This is the reason for the volatility of the markup phase. You might awaken one morning to find silver has surged by $4. You might go to lunch and discover it has climbed another $3. The media will decry it as a bubble, but it is not a bubble. It is price progression through a vacuum, seeking the next reservoir of liquidity. Based on my analysis, the subsequent significant liquidity zone, the next point where sellers might emerge, is the inflation-adjusted peak of 1980, which is substantially above $100. The vacuum serves as the critical zone for short sellers, and we are poised to enter it. Before we celebrate, I must issue a caution. The financial institutions are also cognizant of this vacuum. They understand that if the $65 level breaks, their positions are imperiled. Therefore, before the dominant entity permits the price to ascend, we often witness one final aggressive maneuver, the stop run. Immediately preceding a breakout, the price might experience a sharp, albeit temporary decline. It could drop from $63 to $61 in just 5 minutes. The purpose is to trigger the trailing stop losses of those who purchased at lower levels, to shake out any remaining apprehensive investors, and to confirm the absence of further selling pressure. This is the springboard. If you observe a sudden, inexplicable price drop within the next 24 hours, do not panic. Assess the trading volume. If the price declines on low volume, it is a deception, a false signal. The dominant entity is testing the periphery, inspecting the defenses for any weaknesses before unleashing the upward trend. If you sell during such a dip, you are essentially relinquishing your opportunity just before the significant move occurs. Maintain composure. The underlying structure is bullish. The accumulation is genuine. The volatility is merely the engine revving. The most difficult aspect of investing is not entering at the bottom, but holding on to a winning asset. When silver reaches $70, you will feel exceptionally astute, experiencing substantial profits. Your primal brain will urge you to sell and secure your gains, warning of a potential decline. This is your most perilous instinct, as you are thinking in terms of fiat currency profit, calculating, "I've made $10,000. However, you are measuring your wealth in a currency that is rapidly depreciating. If you sell your silver at $70, what do you receive? You receive dollars. What will you do with those dollars? Purchase overvalued stocks? Invest in bonds with negative real yields? Keep them in a bank account where inflation erodes their value? If you exchange a tangible asset for a less stable currency at the inception of a major upward cycle, you are essentially trading a price racehorse for a pile of hay. The dominant entity is not selling at $70 nor at $80. They are not selling at all. They are consuming it. You must adopt the perspective of the dominant buyer. You are not trading silver. You are investing in it for the long term. You should only sell if you intend to acquire something tangible, such as property, land, or a business. Never sell solely to see a larger number in your checking account. The allure of selling prematurely will be immense. The price fluctuations will induce discomfort. However, recall the energy crisis. Remember the substantial buy order. The fundamental forces driving this movement will persist for years, not mere weeks. Do not prematurely consume your rewards. We have arrived at the conclusion of this analysis. We commenced with a stagnant chart at $63. We uncovered a clandestine buyer investing $650 million. We linked this to the $30 billion expenditure on artificial intelligence infrastructure and charted the vacuum effect leading to $100. The narrative of silver in 2025 is not about inflation. It is not about the Federal Reserve. It is about the fundamental principles of physics. We are endeavoring to construct a futuristic society, reminiscent of Star Trek, using a supply chain from the Victorian era. We are attempting to electrify the globe with a metal that we have ceased mining. The mathematical equation does not balance, and when the mathematics of a commodity market are unbalanced, the price must resolve the equation. The price must escalate sufficiently to either diminish demand or stimulate supply. We are entering an epoch of scarcity. For the first time in your lifetime, you will encounter items that you are unable to purchase. Out of stock will become the defining phrase of this decade. By holding silver today, you have secured a favorable position. You have preempted the actions of the world's largest corporations. You have transmuted your paper currency into strategic energy. The dominant buyer has finished acquiring. The substantial buy wall is dissolving. The vacuum is expanding. Relax, observe the unfolding events, and maintain your holdings.